Okay, so annuities is definitely on every test, Mercedes, of every state of the United States. Okay, so every test that you're gonna take, so it doesn't matter if you're watching this for California,
Mhm.
or for anything else, it's on every test. So let's go over annuity. So here we go. So select chapter, annuities. What is an annuity, by the way? Why is annuities, by the way, is a savings program. So why is it in the insurance exam? If it's a savings program, why is it in the insurance exam? And the answer is because the answer is because it has an insurance component, and the insurance component is what protects the savings. So annuities is a type of savings program, type of investment vehicle, right? Where you're able to save for retirement, like in an IRA, or just save for the future. The benefits of annuities is that the savings grows tax deferred, okay, and and the savings grows tax deferred, and confirm resubmission. Give me one second. And the savings grows tax deferred, and then it pays you an income that you cannot outlive. Okay, that is the whole purpose of annuities. So let's scroll down real quick through the chapter here. Okay. So there's a deferred annuity. Deferred annuity means that the income doesn't pay until 12 months later, right?
Okay.
Immediate annuity. So the opposite of that is an immediate annuity. An immediate annuity is an annuity that let me minimize this. Yeah, there we go. So an immediate annuity. So this is the deferred annuity part right there. So an immediate annuity is an annuity that pays immediately. That pays immediately within 12 months. Within 12 months, okay? So
Okay.
deferred life contingency means that it depends upon whether the person is dead or alive. Life contingent, that's what that means right here. Liquidation means that you're cashing out, okay? Like cashing out, if something is liquid, that means you could take money out, okay?
Okay.
All right, give me one second, because this thing keeps calling my name. All right, cool. All right, so liquidation. Next one, natural person is a human being. That's a dumb, right? Page that you're looking, users information you enter, returning to a page. I don't know why it keeps doing that. Keeps refreshing on me, deleting my highlights. Qualified plan. Qualified plan means that the IRS has a favorable tax treatment to it. So, like for example, 401k is qualified. An IRA is qualified. That means that you get tax treatment like tax deferrals, tax deductions, tax free, stuff like that. Okay. So that
Okay.
means qualified. Let's keep going. Things that are going to be big on the annuities, right? On the annuities. So annuities, check it out. Annuities was to liquidate an estate. To liquidate an estate. What does that mean? That means to cash out money you saved. That's really what annuities was created for. Oh, cool. I'll just press cancel. All
So
right.
pretty much like another savings account.
It's like a savings account, but it's made to save money for retirement so that it produces income. It liquidates an estate. It produces income. It's the same thing. I'm saying the same thing, okay? I'm just using test lingo.
Mhm.
Liquidation of an estate means it produces income for your retirement. That's what it means. It's super simple, man. It's just a
So how
test
much
test
like
lingo.
so what do you how do you open one? What how
How do
much,
you open one?
yeah.
Yeah, Primerica has those. You could open one with Primerica.
Hmm. Okay.
So so basically it's just like, you could go to your bank and say, "Hey, I want an annuity." All right, well, we're going to set you up with a financial advisor. I'm going to schedule an
Okay.
appointment with you in 3 months. They're usually not available, guys. but yeah, with Primerica, we open annuities, but there's certain requirements, right? But yeah, you have to qualify for an annuity.
Ah,
So
so do you have to qualify it at your bank as well?
yeah, everywhere. Yeah, you can't because
Oh, okay.
annuities, because watch, annuities, the money you put in, you can't take it out. There's penalties. There's like a 7% penalty.
Hmm.
So you don't want to put annuities, you don't want to put your money in annuity if you're going to need it in 3 years or 1 year, right?
Well, no, because if you want to save it for retirement,
Yeah, so there's an owner of an annuity, which is the guy the purchaser, right? Then there's an annuitant, which is the person who receives the benefits or the payments from
so
the annuity.
just like the life insurance.
Yeah, well, in a life insurance, the beneficiary is the one that gets the benefit when the
Right.
owner, when the insured dies. You see what I mean? So it's a
Got it.
little different. It's a little different. This one, you don't have to die to get the benefit. The annuitant gets the benefit when he retires or when he wants to start withdrawing income.
Okay.
Okay. So here it is. The owner pays into annuity. Look at this one right here.
Hmm.
The owner pays into an annuity, and then the annuity pays to the annuitant. Can the owner and the annuitant be the same person? Yeah, I could buy an annuity for me. Does it have to be the same person? No. The owner could buy, like I could buy an annuity for my dad, for example.
Hmm.
Accumulation. Okay. So there's an accumulation period, which is the time that you're saving money or paying into the annuity to grow. And then there's the annuity period, which is the time when the money is being cashed out. Got it?
Okay.
So accumulation period, annuity period. You got to know that. Annuity period is a pay-in period. The accumulation period is a pay-in period. The annuity period is also known as the annuitization period, the liquidation period, the payout period. Okay, has a lot of names on the test.
Okay.
So when you pay into it, you're accumulating. This is a good one right here. Screenshot that right there. This is a good one.
Yeah.
The annuitization period is a payout period. That's good. That's a really good. Let me highlight this. This is good actually. I'm gonna post this up on the Telegram. This is a good one. Good stuff on annuities. Oops, I misspelled annuities. All right, let's keep going. Let's keep going. Let's keep going. Types of annuities. There's a lot of types. Let's keep going. I'm just taking you to the okay, payment options. Okay, you could pay it with a single premium. So you could, like, for example, let's say you worked at Marriott's Desert Springs for 30 years of your life, and then you retire and you were putting into your 401k for the past 30 years. So let's say you accumulated a good chunk of money, $400,000 in your 401k. So now you have $400,000. You want to put it into an annuity because you want to start receiving income because you're retired. So you funded that annuity with a single premium, $400,000 lump sum. Does that make sense?
Hmm.
But on the test, it says single premium. Or let's say you start in Marriott's Desert Springs, scenario number 2. Marriott's Desert Springs doesn't offer you a 401k, so you go to your local Primerica representative and you say, hey, I want to open up a retirement plan through an annuity. So this one's going to be a periodic payment starting with zero, making, let's say, $500 a month into your annuity. And it's going to accumulate in 30 years. Let's say it grows to 400, $500,000. And now you accumulated money into the annuity. All right.
Periodically, so every month.
Periodically, yes, every month.
Okay.
Yeah, this is good stuff, man. This is actually a good way to learn annuities. I like these charts. I never seen these charts before. This is cool. So once you have the annuity, you're gonna, oh man, this is so good. I'm gonna copy and paste this again. So this premium payments. All right, let me put this in the annuity. This good stuff right here. All right, and then I'm gonna go down right here. So this is accumulation period. Annuitization period right here is how you get the money. When do you get the money? Immediate annuity. I went over that, right? Immediate means that you get the money within a year. So income starts within a year. And then um, if payments begin after 1 year, then it's called a deferred annuity.
Hmm.
These are good right here. These are good. Yeah, this is good stuff. So an immediate annuity, you're basically purchasing it on a single payment because you put in a big old lump sum, then you start getting payments right away within 12 months. That's an immediate annuity. All right.
Okay.
Annuities have a surrender charge. You see this right here?
Hmm.
So it might be 7 years on the first year, then it goes down 6%, 7% on the first year, 6% on the second year. So the annuity goes down to zero as you have the annuity longer. You see what I mean?
So, like, if you have to take out the money, like if
If
you
you,
take it out for the first year, it's a 7% penalty.
yeah, yeah, yeah.
Okay.
This is a good chart right here that you can see. You have to take money out, it goes down. Yeah, this is good, man. This is good stuff right here. Annuities is going to be on the test. So I'm glad you're understanding annuities right now because this is going to be on the test for sure. Okay, so annuities are an investment. So there's different investment options. You could, so one of the ways to invest it in is in a fixed annuity. A fixed annuity is very conservative, you know? I mean, the name says it all, fixed, right? That means that that means that it grows. There's a guaranteed minimum interest rate. All right. Um, income does not do not vary. The income payments does not vary because it's fixed. It's a fixed interest rate. Okay. The insurance company guarantees a specific dollar amount in each payment because it's fixed. The word fixed says it all, okay? So it's not gonna
Yeah.
vary at all. It's not gonna fluctuate. It's just gonna be like a guarantee, like 2%, 3%, guaranteed. See what I mean?
Hmm.
All right. Now, so the benefit is called level benefit payment amount. That's a fixed annuity. All right. Oh yeah. Fixed annuities are deposited into a general account. This is really important. Okay. General account. So let's say you're a client, you give me the money, I'm an annuity company, insurance company. I'm gonna put that money in a general account. In my general account. That means my own account. Because I guarantee the interest rate, so I'm not gonna lose money. You see what I mean?
Mm.
But if it's in a separate account, that means I don't want to lose money. That means it's in a mutual fund, and I don't want to lose my money. So I'm gonna put it in a separate account. Okay. So I'll show you what type of annuities are invested in separate accounts. Okay. I'm gonna talk about that right now. All right. Next type of annuity. Here it is. Equity index annuities. Oops. Equity index annuities are invested in the Standard and Poor's 500. Check it out. It's annoying. Standard and Poor's 500. You see that?
Hmm.
So a index annuity is like a fixed annuity, but the difference is that um, there's a guaranteed minimum, okay, just like fixed.
Okay.
But if the interest rates go up in the S&P 500, then this annuity is gonna get part of the gains. So for example, let's say the interest rate is 4% right here, right? 4%. So what's gonna happen is that if the annuity goes up to 12%,
Mhm.
right? Then you're not gonna get 4%. You're gonna get like a cap, like in this case 8%. You see what I mean? But what if the S&P 500 does negative? If it does negative, then guess what? It stays at the guaranteed minimum, 4%. Got it?
Okay.
All right, all right, all right. So it protects it. It protects it. Now the next one is variable. This is where it's in a, and by the way, in a fixed annuity, it's also in a general account, also general account. But on a variable annuity, the word variable says it all. It varies, right? It's not guaranteed, it's not fixed. This one is going to be in a separate account for sure. Separate account. Separate account. You need it's in a mutual fund, all right? It has underlying investments. That means it's invested in the stock market. It has a portfolio, investment portfolio right there. The interest rate does not guarantee a minimum interest rate. All right, that's really important to know on variable annuities. License requirements to sell anything that has, by the way, to sell anything that has the word variable, you not only need your life license, you need also your securities license. Securities license. Thank you, babe.
Okay, to sell something?
To sell variable annuities, you need
Okay.
your life insurance license and your securities license. That's going to be on the test for sure. Because variable annuities, there's also variable universal life. Variable universal life is a life insurance, not an annuity. And that one also has the word variable in it. Anything that has the word variable in it, you need a securities license on top of your life license.
Wow. Okay.
Oh, I love this chart. This chart is awesome. I'm gonna screenshot this chart. This chart is awesome. Look at this. This chart tells you exactly what I'm talking about. So let me post this on the link here. This is an awesome chart. Look at this. It says features. Interest rate on a fixed annuity is guaranteed by insurer. On a variable, not guaranteed because it's invested in the stock market. Underlying investments. Underlying investments, it's in the general account. On a variable, it's in a separate account. You see that?
Mm-hmm.
License needed, life insurance license only on fixed annuity. But on variable annuity, you need your life plus securities license. This is good stuff right here, man. Master this chart. Have this in your phone always, dude. You just repeat this over and over. Expenses, it's guaranteed and guaranteed. The expenses are, that means you're gonna pay a fee. Income payments. Income payments are guaranteed on a fixed annuity and index annuity, but is not guaranteed on variable. Why? Because it all depends on the stock market portfolio. And the stock market goes up and down, right?
Mm-hmm.
All right, cool. Good stuff, good stuff. I love this. This annoying thing keeps popping up. Market value adjusted annuity. This one's not gonna really be on the test, but hey, let's go over it real quick. It's a modified guarantee MGA. Let's go past this. It's not gonna be on the test. I haven't seen it often. Annuity benefit payments, life payments, annuity benefit payments. All right, these are benefit options, payout options. Okay, so how do you get your money? You could get your money many different ways. One of them is, for example, oh, here they are right here. Look at this. Life with period certain, life with refund, joint life, joint and survivor. You got to know those. You have to know those, okay? So let's talk about it. Life, pure life is also known as life only and straight life. You got to know that. Pure life, straight life, life only. I know they're bastards for doing that, but that's the way it is. They want to make it harder on you. Next one. So this one is this one right here. Pure life, life only, straight life. Gives the highest monthly benefit out of all of them. You got to know that. Okay. Now let's go to the next one. Life with guarantee minimum. It also pays for life if you outlive the certain guaranteed minimum period, like let's say 20 years. It pays you if you live past 20 years, it'll pay you for life. But if you die, let's say in 5 years, well, you still got 15 years left out of the 20 years. So it's gonna keep on paying for 15 years to your kids or your spouse.
Okay.
Make sense? Any
Makes
questions
sense.
so far?
I thought I would lose it.
What's that?
I thought I would lose the difference.
Not on a guaranteed minimum. On life only, you do. Pure life, life
Okay.
only, straight life, you definitely do. If you die early, you'd lose the benefit. Okay.
Okay.
All right. All this stuff is gonna be on the life insurance exam, guys. All right. So if you're wondering, is this gonna be on the test? Yes, it is. On all tests in all 50 states, they all talk about annuities. All right, let's keep going. Oh shoot. Okay, it's time. Um, Dang, classes done. I'm gonna fly through this real quick, cause I want to give you guys, let's see, cash refund, installment refund, life period with certain no, not that one. Let me not highlight this. Single life, multiple life. Okay, here it is. Joint life. Joint life pays out for two people, but then it stops on the first death, first to die. Joint and survivor pays for two people or more, but it stops when the last one lives, right?
Hmm. Hmm.
Uh, so when the last one dies, it stops. Just like life insurance benefits. Okay, this is good to know because this is also on the life types of policies chapter, and since it's on the type of policies chapter, you might as well master this also. Okay. Yeah, this is good to review right here. You know, the videos, watch the videos. The videos are pretty cool. And then we were gonna take some quizzes, but we're not gonna do it today. We're pretty much done with our class today. So, um, so yeah, that's pretty much